Welcome to our exploration of how economic trends shape the world of investment banking. In today's fast-paced financial landscape, understanding the interplay between macroeconomic shifts and banking strategies is more crucial than ever. From global recessions to periods of rapid growth, economic trends influence everything from deal flow to risk management. In this video, we'll break down the core economic factors that drive changes in investment banking and examine how banks adapt to these shifts. Let's begin by looking at what economic trends really mean and why they matter for investment banks. Economic trends refer to the general direction in which a country's economy is moving over a period of time. These trends can be influenced by factors such as GDP growth, inflation, employment rates, and consumer confidence. For investment banks, tracking these indicators is essential for forecasting market movements and advising clients. By staying ahead of economic shifts, banks can position themselves to seize new opportunities or mitigate potential risk. Let's dive deeper into the specific economic indicators that investment banks monitor closely. Investment banks rely on a range of economic indicators to guide their strategies. These include GDP growth rates, inflation figures, interest rates, and unemployment statistics. Each of these metrics provides valuable insights into the health of the economy and potential market movements. For example, rising interest rates might signal tighter monetary policy, affecting borrowing costs and investment decisions. By analyzing these indicators, banks can better predict shifts in market sentiment and adjust their services accordingly. The economy moves in cycles, alternating between periods of expansion and contraction. Investment banks must adapt their strategies to these cycles. During expansions, deal activity often increases, with more mergers, acquisitions, and capital raising. In contrast, contractions or recessions typically lead to reduced deal flow and heightened risk aversion. Understanding where we are in the economic cycle helps banks allocate resources efficiently and advise clients on the best course of action. Interest rates play a pivotal role in investment banking. When central banks adjust rates, it impacts borrowing costs for companies and individuals. Lower rates often encourage borrowing and investment, leading to increased activity in capital markets. Conversely, higher rates can slow down deal making as financing becomes more expensive. Investment banks must constantly monitor interest rate trends to anticipate changes in client demand and market conditions. Inflation affects the value of money and the cost of doing business. For investment banks, rising inflation can erode returns and increase uncertainty. It may also prompt central banks to raise interest rates, further impacting market activity. On the other hand, moderate inflation can signal healthy economic growth, supporting robust deal flow. Investment banks must assess inflation trends to help clients make informed decisions about investments and financing. Global economic trends such as increased globalization have expanded the reach of investment banks. Banks now operate in multiple markets, navigating diverse regulatory environments and economic conditions. This globalization brings both opportunities and challenges, as banks must adapt to shifting trade policies, currency fluctuations, and geopolitical risks. Staying attuned to global trends allows investment banks to offer clients a broader range of services and access to international capital. Technology has transformed investment banking, enabling faster transactions, improved data analysis, and greater efficiency. Economic trends often drive technological adoption, as banks seek to stay competitive in changing markets. Innovations like artificial intelligence and blockchain are reshaping how banks operate and interact with clients. By leveraging technology, investment banks can better respond to economic shifts and deliver enhanced value to their clients. Economic trends often prompt regulatory changes that impact investment banking. For example, financial crises may lead to stricter oversight and new compliance requirements. Investment banks must stay informed about evolving regulations to avoid penalties and maintain client trust. Adapting to regulatory shifts is an ongoing challenge, but it also presents opportunities for banks to differentiate themselves through robust risk management and compliance practices. Effective risk management is at the heart of investment banking, especially during periods of economic uncertainty. Banks use sophisticated models to assess market, credit, and operational risks. By understanding economic trends, investment banks can adjust their risk exposure and develop strategies to protect both their own interests and those of their clients. This proactive approach is essential for long-term success in a volatile economic environment. Economic trends directly influence deal flow in investment banking. When the economy is strong, companies are more likely to pursue mergers, acquisitions, and public offerings. Conversely, during downturns, deal activity often slows as uncertainty rises. Investment banks must gauge market sentiment and adjust their pipelines accordingly, ensuring they are prepared to capitalize on opportunities or weather slow periods. One of the key roles of investment banks is to advise clients on navigating economic trends. Whether it's helping a company raise capital during a boom or guiding them through restructuring in a downturn, banks provide tailored advice based on current economic conditions. This client-centric approach builds long-term relationships and positions banks as trusted partners in both good times and bad. Economic trends often drive innovation in financial products and services. Investment banks develop new offerings to meet changing client needs, such as green bonds during periods of environmental focus or structured products in volatile markets. By staying ahead of trends, banks can differentiate themselves and capture new market segments, ensuring continued growth and relevance. Major global events such as pandemics or geopolitical conflicts can rapidly alter economic trends and disrupt investment banking. Banks must be agile, quickly reassessing their strategies and risk exposures in response to these shocks. The ability to adapt to unforeseen events is a hallmark of successful investment banks, ensuring resilience in the face of uncertainty. Summary: economic trends have a profound impact on investment banking, shaping everything from deal flow to risk management and client services. Closely monitoring economic indicators and remaining agile, investment banks can navigate uncertainty and seize new opportunities. As the global economy continues to evolve, the most successful banks will be those that adapt quickly and provide innovative solutions for their clients. Thank you for joining us on this journey through the dynamic relationship between economic trends and investment banking.